Cineplex is seeing a steep decline in its stock. Currently, the company is $8 per share, which is a 77% drop from its most recent peak. It was once a company worth $3 billion at its all-time highs in 2017, but now it's at $500 million. Prior to the COVID-19 shutdown, the company was in process of being acquired by Cineworld, a UK-based theater. They offered to buy Cineplex at $34 per share, but that deal has long faded away since social distancing rules came into play and it immensely hurt the operations of both companies. Adding to pains, Cineplex is expecting financial issues in the future with paying down its debts due to so many months of being on pause, and theater attendance already going downhill over the years with the trend of online movie platforms like Netflix, YouTube, Disney, Amazon, and even Apple. Right now, the company has around $2 billion in combined debt and lease obligations. The amount owed is 4 times the company's current worth of $500 million. In a normal world without COVID, its debts would still be manageable with money it generated from doing business, but having operations pause too much, the little amount of cash it has on hand, and all lines of credit almost fully drawn, it can be pretty difficult to keep going without additional financial resources. You're probably wondering, so what's next? With Cineplex's market value testing new lows, it can attract potential acquirers once again. I wouldn't be surprised if cash-rich prospects like Amazon, Apple, or Disney were potential buyers and plan to set up exclusive theaters for their films, gaining great locations across Canada. But my most likely guess is a large investment firm like Onyx could buy the company and take it private to operate. In fact, back in 2001, Cineplex filed for bankruptcy and was subsequently bought by a group of investors led by Onyx. Cineplex then restructured its operations, which included shutting down 25% of its screens before going public in 2003. If Cineplex decides not to be acquired and continues operating independently, then it could start closing down its least profitable locations on its own and just stick with its most populated areas. At the end of the day, I suspect that the business will be forced to downsize and it will double down on its premium services. Shopify, on a huge contrast, has become the fastest growing Canadian company this decade and is now the biggest company in Canada. For context, Shopify is now 304 times bigger than Cineplex, even though they have similar sales. Some say that the compensation and difficulty of becoming a software engineer in Shopify is comparable to the big US tech companies like Google and Facebook, so it's very much respected as such. With the e-commerce platform still seeing a lot of usage and new growth in various countries, there's still a long runway for it to keep pushing forward. As of today, Shopify is now larger than any of the Canadian banks. Just comparing the market capitalizations, the company is 17% bigger than RBC, which is now the second largest Canadian company, and at its size, Shopify could take over the bottom 3 Canadian banks combined. But when you compare the revenue or sales that each generates, it's a stark difference. And although Shopify isn't a bank, even though it does provide small loans to its platform users, it really speaks to how much investors care nowadays about what a company currently makes. But of course, the stock market is forward-thinking and loves growth potential. Simply faster growing companies that can grow consistently are much more appreciated by investors, just so long as they can produce some evidence of profits. Here's how much their revenues grew in the most recent year. Shopify is clearly much faster in growth. So maybe the Canadian banks are in a good comparison, and a lot of people like to think of Shopify as the up-and-coming Amazon. With amounts in Canadian currency, if we make a comparison of the two, Amazon is currently 12 times bigger in market cap, has around 200 times more in revenue, and grew revenues at less than half the rate in the most recent year. If you go back to when Amazon was the same size as Shopify, which was back in summer of 2013 at $300 stock price, compared to Shopify's revenue, it was still 39 times bigger, but the growth rate was consistently half the rate. If you assumed Shopify keeps its pace of 47% revenue growth every year, it would take another 9 years to match the old Amazon's $77 billion in sales. With these numbers, you might be thinking that Shopify is overvalued, so what's going to keep pushing the stock up? Personally, I think it has to be a combination of even higher growth rates and profitability. Based on revenues, $2 billion is still small enough to grow substantially, perhaps by acquiring smaller companies, making more brand deals, and if they continue to see a surprisingly huge adoption of their platform by customers in existing and new geographies. As for profitability, Amazon currently takes home around 5% of the revenue it generates. Back in 2013, that was 1%. Right now, Shopify is at 3% on an adjusted basis, and getting close to that 5% mark fast, even though it's still in an early high-growth spending phase. I suspect that as a cloud-based company, in the long term there will be more in the lines of Google and Amazon Web Services with a 25% profitability in the future if they spend less from letting automation do most of the work and the revenues continue to rise. So that's all for now. If you enjoyed watching this video, remember to press the like button and subscribe to my channel if you haven't already. Let me know in the comments below what your thoughts are on the future of Cineplex and Shopify.